Hello guys, welcome back to another revision video. Today we are going to revise AS26 Intangible Assets. A simpler standard, if you have finished property, plant and equipment, most of the concepts or core concepts get covered there itself. But here there are slight differences compared to AS10. To be frank, accounting is more strict with respect to intangible assets compared to tangible assets. They are slightly comfortable with tangible assets because you can touch and see something. But with respect to intangible assets, accounting is quite strict. Accountancy is quite strict with respect to these intangible assets. Obviously, because you cannot see them or touch them. This is mainly to avoid recognition of some assets which are actually not existing. So the concepts are in a way almost similar to what we studied in AS10. We'll be focusing more on the differences here or the new points here. For example, there is guidance on research and development which is not there in AS10. So those extra points is where I'll be stressing a lot in AS26. Let's get started. First section, definition of an intangible asset. Intangible asset is an identifiable non-monetary asset for which there is no physical substance. You cannot touch it or see it. There is no physical substance for intangible assets and it needs to be identifiable. Identifiable means it is something other than goodwill. In other words, identifiable means the asset should be separable. You should be able to sell that or lease that or rent that out separately from business. Only then it can be called as an identifiable intangible asset. Remember, goodwill is not an identifiable asset because goodwill cannot be sold separately from business. If you have to sell goodwill, you have to sell the business also. So actually, goodwill is not an identifiable asset. Goodwill does not meet the definition of intangible asset as per AS26. Goodwill is not dealt by AS26. Many of them don't have this clarity. They think goodwill is covered by AS26 because goodwill is also an intangible asset. And many of you, the first intangible asset that you would have learnt in school is goodwill. So you all think that goodwill is covered by AS26. No. Sir, then which standard covers goodwill, sir? If it is an amalgamation goodwill, AS14 will cover. If it is consolidation goodwill, AS21 will cover. But AS26 will not cover. Actually, goodwill does not satisfy the definition of intangible asset as per AS26 because it is not identifiable. It is not separable from the business. Okay. And obviously, an intangible asset is held for use in the production or supply of goods, or for rental to others, or for other administrative purposes. Sir, then what if an intangible asset is held for sale, sir? Suppose my business is buy software, sell software. In that case, that intangible asset software will be accounted under AS2, not under AS26. Here only those intangible assets which are held for other than sale. In other words, those intangible assets which are held for use in the business are only covered by AS26. Okay. And then there are certain small points. For example, if an intangible asset is there in a physical substance, just because an intangible asset is there in a physical substance, you cannot call it as tangible asset. For example, software is stored inside a CD. Now, just because you can touch the CD, you cannot say, yeah, this is a tangible asset. No, you're giving more importance to the software that is there inside, not to the CD. So here intangible asset is predominant. So it is actually an intangible asset. Okay. And one more point which AS26 says is any intangible asset which is an integral part of a tangible asset means without that intangible asset, the tangible asset cannot run. For example, there is a computer in front of me. In that computer, there will be operating system. Without that operating system software, which is an intangible, this monitor, keyboard are of no use. So that operating system, which is an intangible, is an integral part of this tangible system. In that case, that operating system software in the financials will not be shown under intangible asset. It will be shown as a part of tangible assets. So keep it in your mind very, very clear. Any intangible asset, if it is an integral part of a tangible asset, that means without that intangible asset, the tangible asset will not run. Then that intangible should be classified as a part of tangible. It should not be shown separately in the financial statements as intangible assets. Okay. I hope you're clear with this definition portion. Now let's come to initial recognition. Remember, initial recognition of an intangible asset is always at cost, always at cost. Same like what we learned in AS10. AS10 also says initial recognition of a PP is always at cost. Here also initial recognition of an intangible asset is always at cost. Okay, cost, you all know, cost means whatever we have sacrificed. We also learned the three inclusions in cost: cost of purchase, directly attributable cost, and restoration decommissioning liability. Here restoration decommissioning liability and all will not be there, because you cannot touch an intangible asset. What will you restore? Okay, so here we will have cost of purchase, which is same as what is given in AS10. Take the purchase price, add non-refundable taxes, indirect taxes without ITC, and subtract if there is any trade discount and any other directly attributable costs which are incurred to make this intangible asset ready for use. Like for example, certain intangible assets needs to be registered with the government. So such registration fees, legal fees, those can also be added to the cost of an intangible asset. So initial recognition will always be at cost. Now this intangible asset can be acquired in different ways. Okay, you can separately acquire an intangible asset. That is, you can go and buy. If I want, I can go and buy a software. Then whatever is the amount that you have paid or whatever you have sacrificed is the cost. Okay, here only one thing: if any intangible asset is acquired by exchanging securities, that means I am giving my shares or I am giving my debentures and then acquiring an intangible asset, then that intangible asset will be recorded at fair value of the intangible asset that you are purchasing or the fair value of the securities that you are issuing, whichever is more clearly evident. This point is actually not very clear in AS10. AS26 specifically says whenever you are purchasing an intangible asset by giving away shares or debentures, those are called as securities here, then the cost of that intangible asset will be either fair value of the intangible that you have acquired or the securities that you have issued, whichever is more clearly evident or whichever is more reliably measurable. Okay, so whenever you separately acquire an intangible asset, it should be measured at cost. Sir, what if I acquire as a part of amalgamation? In that case, first thing, you all would have already learned AS14. In that, AS14. I'm sorry, it is AS14. In that we have two types of amalgamations: amalgamation in the nature of purchase and amalgamation in the nature of merger. So first thing, you have to identify whether your amalgamation is the nature of purchase or it is the nature of merger. If it is the nature of purchase, then whatever intangible asset that you are getting as a part of amalgamation, it should be recorded at fair value. But if it is merger, then whatever intangible asset that you are getting from that amalgamating company, you have to record it at the carrying amount that is there in their books. Avanga books la enna amount irko adu apdiye thooki potringa. If it is amalgamation in the nature of purchase only, we have to use fair values. Okay, next. Sir, I didn't purchase, sir. I got this intangible asset out of government grant. Government gave it to me at free of cost. Then simple, you would have learned this in AS12. It should be recorded at nominal value. Sir, government didn't give it to me for free, but they gave it at a concessional price. If the intangible asset normally is costing 1 crore, they gave me at 40 lakhs itself. Then it will be recorded at actual acquisition cost. Okay, so this is how you have to record if you get it as a part of government grant. Sir, what if I do exchange of assets? I am giving one intangible, getting another intangible. Same points as what we discussed in AS10. Sir, if you quickly revise that principle, again, it will be very helpful for us, sir. So whenever there is an exchange, I would have told you in AS10 also, first you have to remember if there is commercial substance. On the exchange, commercial substance irka. Yes, sir, commercial substance is there. Then whatever new intangible asset that you are getting, it should be recorded at fair value of the intangible asset acquired or fair value of the intangible asset given up, whichever is more reliably measurable. Edu innu reliable measure panna mudiyumo and the fair value use panni we have to record. Sir, what if I know both? Then you have to give preference to fair value of the intangible asset given up, because that is the sacrifice that you have made. Okay, sir, what should I do if there is no commercial substance? Remember last time I told you one key point that you have to remember if there is no commercial substance is, if there is no commercial substance and the exchange or a journal entry P&L should never come. P&L should never come. Remember this point very, very clearly. P&L should never come in the journal entry when there is no commercial substance. So then what we should do, whatever is the carrying amount of the intangible asset that you have given up, that will become the carrying amount of the intangible asset that you have acquired. Okay. So this is on exchange of assets. Sir, what if the intangible asset I have not acquired, but I have internally generated this intangible asset, sir? In that case, first thing, if it is an internally generated asset, first check whether that asset is goodwill, brand, masthead, customer list, publishing title. Check whether it comes under these assets. If it's a part of these assets and they are internally generated, AS26 very clearly says, sir, no entry, you should not recognize them. You are not allowed to recognize these assets. Okay. Next, if, sir, it doesn't fall under these, some other asset I am internally generating, sir, I am generating a software. Andamari, if some other intangible asset you are internally generating, then AS26 clearly says, split it between research phase and development phase. If you are spending money and you are still in research phase, whatever amount you have spent, that should be charged to P&L. It cannot be capitalized. It should be treated as a revenue expenditure. Revenue expenditure. It should be taken to P&L. No, sir, I am in development phase, sir. In that case, there are certain conditions which are given in AS26, like it should be technologically feasible. You should have enough resources to complete. You should have intention to complete. You should demonstrate that there will be benefits from this project. And the money conditions, if they are satisfied, then whatever money you have spent can be capitalized. But if those conditions are not satisfied, again, whatever money you have spent in development phase should be charged to P&L. So this is also one important point because this is not there in AS10. So remember, research phase, expenses off to P&L, development phase, conditions not satisfied, expenses off to P&L, conditions satisfied, it can be capitalized. It can be capitalized. I have given that point here on internally generated brands, mastheads, publishing titles, customer list, and items which are similar to these cannot be recognized as intangible asset only if they are internally generated. If you are separately acquiring them, then you can account them. Okay. And then certain costs like general administrative cost, abnormal losses, any initial operating losses, training cost, advertisement cost, all these can never be capitalized and shown as an asset. All these should be charged to P&L. Should be charged to P&L. Remember this also. Next point. Now what AS26 says is, you are spending some money. If it is satisfying tangible asset definition, okay, AS10, you can capitalize. If it is satisfying intangible asset definition, AS26, capitalize. Or if you are spending this money as a part of amalgamation, it will either go to goodwill or capital reserve. In all other cases, any other money spent, if it is not satisfying the definition of tangible asset, if it is not satisfying the definition of an intangible asset, if it is not a part of amalgamation, then all the other expenses should be charged to P&L. It should be recognized as an expense in P&L. You can never capitalize. You can never capitalize. They have also given certain examples like expenditure on startup activities. This is also called as preliminary expenses. Preliminary expenses. Preliminary expenses, ennikume you can never capitalize and amortize. Don't think, sir, Income Tax Act, Section 35 allows over a period of 5 years, sir. That is Income Tax Act, sir. AS26 is very clear. Preliminary expenses should be completely charged to the P&L in the year in which it is incurred. No capitalization of preliminary expenses is allowed. Training cost also should be charged to P&L. Advertisement and sales promotion cost also should be charged to P&L. Any relocation costs also should be charged to P&L. These costs can never be capitalized and shown in the balance sheet. So keep it very clear. Any amount spent, is it satisfying the definition of a tangible asset? Yes, go to AS10. Is it satisfying the definition of an intangible asset? Yes, come to AS26. No. No tangible, no intangible. Is it a part of amalgamation? Yes. Then put it in goodwill. No, it is also not a part of amalgamation, sir. Then that expense, which is neither tangible asset, nor intangible asset, nor incurred during amalgamation, that expense should be taken to P&L. No other option. Training cost, advertisement cost, preliminary expenses, relocation cost should be charged to P&L. These cannot be capitalized. This cannot be capitalized. Okay. Sir, now initial recognition is okay, sir. We learned what to do if it is separately acquired, what to do if it comes as a part of amalgamation, what to do if it is a part of government grant, what to do if it is internally generated. This is what we learned in initial recognition. Sir, now I have initially recognized. Subsequently, what I can do, sir? Like AS10, we have cost model or revaluation model. Here also we have that option, sir. AS26 says, Nirth, here no revaluation model, only cost model. Remember, AS26 does not allow revaluation of intangible asset. You cannot revalue an intangible asset. It should be carried only at cost model. That means whatever cost you have recognized initially, that should be amortized. If there is any impairment, that asset also should be impaired. No revaluation model is allowed. Sir, okay, revaluation model is not allowed. It is always cost model. Agreed. But after initial recognition, if I spend some money for that intangible asset, can I capitalize that up? Here AS26 says, whatever money you have spent subsequently, is that increasing the level of economic benefits? Yes, sir, it is increasing the economic benefits that I will get. Yes, now, then you can capitalize. No, sir, it is only maintaining the existing economic benefits now. It cannot be capitalized. It should be taken to P&L. And remember, any subsequent expenditure that is incurred on brands, mastheads, customer list, publishing titles, and other similar items is always recognized as an expense in P&L. It can never be capitalized. It can never be capitalized. Is it clear? Last two sections. More very near to AS10, so you can easily revise this very quickly. Keep certain important points as research and development only. No revaluation model is another one. Now in amortization, we have certain small differences. Those are mainly important points. Mattapadi, this is almost similar to our AS10. Amortization, like how you call as depreciation for PPE, here for intangibles we call it as amortization. Sir, how to calculate this depreciable amount? Cost minus residual value, which will be divided by useful life. Okay, and amortization starts once the asset is ready for use. Same thing as AS10, not put to use. Ready for use is important. Here there are certain points in AS26 which is not there in AS10. So please listen to this carefully. AS26 says the maximum life that you can take for an intangible asset for the purpose of amortization cannot exceed 10 years. It says maximum life that you can take is only 10 years. If you want to take more than 10 years, then AS26 says, take it, okay. But what I want you to do is, you should do the impairment test every year. AS26 says, Olunga maximum 10 years eduthuko. In that case, you can do impairment test only if there are indicators of impairment. No, sir, I want to take more than 10 years. Take it. But then you have to do impairment test every year, whether or not there are indicators of impairment. So maximum life that is allowed is 10 years. And actually there is one point in AS10. AS10 says that you cannot charge depreciation in the ratio of revenue that you will be generating from that asset. I am repeating this again. In case of PPE under AS10, a PPE cannot be depreciated in the ratio of revenue or cash flows that are generated from the usage of the asset, but no such restriction exists in AS26. So remember in exam clearly, if they are asking you to amortize an intangible asset, that can be amortized based on cash flows, that can be amortized based on revenues, but a tangible asset PPE can never be amortized based on cash flows or revenues. One more important point which is not there in your AS10. Generally, residual value of an intangible asset should be assumed as 0. Again, if you see, our AS26 wants to amortize these intangible assets as fast as possible. That is why they are telling maximum life 10 years. So it will get amortized faster. If you take residual value 0, you will amortize more. So they are putting stricter conditions to make it amortized fast. They want you to amortize this asset faster. So first one, maximum life 10 years. Second one, generally we will take 0. Sir, can I take any residual value other than 0? You can take, provided you are able to prove that there is a market for this asset and that market will exist even at the end of useful life. If you are able to prove that, then you can take residual value, otherwise it cannot be taken. And same way, if there is any change in amortization method or any change in useful life, all these should only be given prospective effect, because these are change in accounting estimates, not retrospective effect. And the last point, only for these two types of assets, that is intangible assets which are under development and intangible assets where you take a life of more than 10 years, you have to do annual impairment testing. You have to do annual impairment testing even if there are no indicators. Remember, normally AS28 says impairment testing should be done only if there are indicators. But in these two cases, that is intangible assets under development and intangible assets where you have chosen to take a life of more than 10 years, you have to do impairment test every year whether or not there are any indicators. And the last point is very simple. If you are disposing an intangible asset, gain or loss on that intangible asset should be taken to P&L. And last point, any intangible asset which is retired from active use and held for disposal, for these type of assets, amortization will stop. Amortization will stop. For these type of assets, amortization will stop. That is intangible assets which are retired from active use and it should be held for disposal. For them, amortization will stop, and whatever carrying amount is there till that date, that will be carried in the balance sheet till this asset is sold. Once the asset is sold, any profit or loss on sale of this asset will be taken to P&L. Able to understand? So these are the main points. If you see from the perspective of concepts, something that is different in AS26 is the definition of intangible asset, research phase and development phase, and the fact that there is no revaluation model in AS26, it is only cost model. And amortization, we have certain differences. Useful life maximum 10 years, residual value generally will be taken as 0. And for intangible assets under development and intangible assets where the life is taken as more than 10 years, for these assets we have to do annual impairment testing. Annual impairment testing. Hope this is very, very clear. So let us see certain interesting sums in AS26. With that, we can close this standard. A very easy standard. You can actually revise it very quickly. So let me just go to the questions. Okay. First one is actually a very simple question. Okay. Mainly he will try to make us emotional by using certain words. A company with a turnover of 250 crores and an annual advertising budget of rupees 2 crores had taken up the marketing of a new product. Okay. It was estimated that the company would have a turnover of 25 crores from this new product. So they want to advertise a new product from which they are expecting a revenue of 25 crores. The company had debited to its P&L account the total expenditure of 2 crores incurred on extensive special initial advertising campaign. See, he will try to tell all this. It is a very big campaign. It is a new product. It is going to give lot of revenue. So you will think, no, this expenditure has benefits. So I can capitalize and show as an intangible asset. No, this is an advertisement expense. AS26 is very, very clear. It should be charged to P&L. It should be charged to P&L. Here, one tip from my side is please don't just conclude by saying, no, the company is right, it should be charged to P&L. You cannot conclude like that. That is, you cannot just write only these two lines. First, write clearly the provision in the standard. See, he is trying to write first, according to AS26, if an expenditure is incurred on an intangible item, it can be recognized only when it is expenditure incurred on intangible asset should be recognized as an expense unless it forms part of the cost of the intangible asset. So only if it is meeting the definition of an intangible asset, you can show it. Otherwise, you should keep it as an expense. And here they are telling AS26 clearly mentions that expenditure on advertisement and promotional activities should be recognized as an expense. It cannot be capitalized. Give this context, write this points from AS26 and then conclude based on the case. It is more like writing a law case study answer. Okay, first write the provisions. You can write it in your own words also, not at all an issue. Ensure you use certain keywords. Okay, more than that you can easily write, others you can write in your own words, and then conclude the answer. Don't try to conclude it directly. Okay, next question. Swift Limited acquired a patent at a cost of 80 lakhs for a period of 5 years, and the product life cycle is also 5 years. The company capitalized the cost and started amortizing the asset at rupees 10 lakhs, okay, per annum. The company had amortized the patent at 10 lakhs per annum in the first 2 years. They bought at 80 lakhs. And the first 2 years, how much amortization they charged? 10 lakhs per annum. So totally 20 lakhs is the amortization. So carrying amount now will be 60 lakhs on the basis of economic benefits derived from the product manufactured under the patent. After 2 years, it was found that the product life cycle may continue for another 5 years. Now they are revising the useful life. Initially they thought total useful life itself is only 5 years. Now after 2 years, actually the remaining life is only 3 years. But they are telling no, not 3 years, it will come for another 5 years. Okay. The patent was renewable and Swift Limited got it renewed after expiry of 5 years. So they can totally use for another 5 years even after 2 years. The net cash flows from the product during these 5 years were expected to be 36 lakhs, 46 lakhs, 44 lakhs, 40 lakhs and 34 lakhs. Find out the amortization cost of the patent of each of these years. Very, very simple. First year 10 lakhs you will charge. Second year also 10 lakhs you charged because you followed the different method. From third year, the remaining 60 lakhs should be amortized in the ratio of these cash flows. In the ratio of these cash flows. Remember that very, very clearly. Okay, so from third year, the 60 lakhs should be amortized in the ratio of the cash flows, which is 36 is to 46 is to 44 is to 40 is to 34. Is it clear? So this can be done only if it is an intangible asset, guys. I told you even during the conceptual revision also, in an intangible asset that can be amortized based on revenues or cash flows, but a tangible asset can never be amortized, can never be depreciated based on revenues or cash flows. Okay. During 20x1, next question we are going to, during 20x1 to x2, an enterprise incurred cost to develop and produce a routine low-risk computer software product as follows. So they are internally developing a computer software. So it is an internally generated asset. So we have to check research phase and development phase. Completion of detailed program and design 50,000, coding and testing 40,000, other coding cost 63,000. Testing cost 18,000, product masters for training materials 19,500, package cost 16,500. Okay. After the completion of phase 2, it was established that the product is technically feasible. That means, guys, remember we learned that in development phase certain conditions should be satisfied. Only then you can start capitalizing. So those conditions got satisfied only after completion of phase 2. That means whatever cost that is incurred till phase 2, condition nahi satisfy hua. Conditions didn't get satisfied. So this phase 1 cost, phase 2 cost should go to P&L. Should go to P&L. Only the cost from phase 3 can be capitalized, which is 63 plus 18, 73, 81,000 plus 19,500, 1,500,000. Sir, what about 16,500? Hey, this is only packing cost. Products or packing cost. This cannot be capitalized. This should be charged to P&L. So only these 3 costs can be capitalized. Able to understand? So read the question clearly. Till phase 2, those conditions didn't get satisfied. So what all expenses we incur, it should be charged to P&L. After this phase 2, only those conditions got satisfied. Only then we can start capitalizing. Only then we can start capitalizing. I hope you are very clear. So in Unipatana, if you see, initially they are building up the answer. They are giving the context from the standard and then they are writing. So ensure you also say for an internally generated asset, research phase, expense it out, development phase, capitalize if conditions satisfied. If conditions not satisfied, don't capitalize, and then write the answer on the amount to be capitalized. Don't directly go to numbers calculation. Okay. Next one. As per the provisions of AS26, how would you deal with the following situations? 23 lakhs paid by a manufacturing company to the legal advisors for defending the patent of a product is treated as capital expenditure. Guys, remember this is applicable both for tangible as well as intangible asset. If you incur any legal fees for a tangible or intangible asset, if that legal fees is incurred at the time of acquisition of an asset, or asset வாங்கும்போது அந்த செலவு பண்ணா, that can be capitalized. Okay, that expense can be capitalized. But after acquiring that, for example, you acquired a plant and machinery. At the time of acquiring that plant and machinery, you had to appoint a lawyer for framing that agreement. That can be capitalized. But after acquiring that plant and machinery, somebody else is filing a case saying that it is my plant and machinery. For defending that case, if you appoint a lawyer, that legal fees cannot be capitalized. That should be charged to P&L. Same way, even for an intangible asset, at the time of acquisition, if you are incurring legal fees, that can be capitalized. But later, after acquisition, to defend your title, if you are incurring any legal fees, that expense, that legal fees should be charged to P&L. It should be a revenue expenditure. It should not be a capital expenditure. So what this company has done is wrong. During the year 20X1 to X2, a company spent 7 lakhs for publicity and research expenses on one of its new consumer product, which was marketed in the same accounting year but proved to be a failure. Simple. When you read the word publicity and research expense itself, you should get to know it should be charged to P&L. A company spent 25 lakhs in the past 3 years to develop a product. These expenses were charged to profit and loss account since they did not meet AS26 criteria for capitalization. In the current year, approval of the concerned authority has been received. The company wishes to capitalize this 25 lakhs by disclosing it as a prior period item. No, not possible. Remember, once you charge some expense to P&L because conditions didn't get satisfied, then later, after that conditions getting satisfied, you cannot go back and open those past expenses and again capitalize. Remember, once an expense is charged to P&L because the conditions didn't get satisfied, after that, even though the conditions get satisfied, you cannot bring back that expense back to balance sheet. Once it has gone to P&L, it has gone to P&L. You cannot restate it. So what the company is trying to do is not possible. A company with a turnover of 200 crores and an annual advertising budget of 50 lakhs had taken up for marketing of a new product by a company. It was estimated, again see marketing expenditure, okay. It was estimated that the company would have a turnover of 20 crores from the new product. The company had debited to its P&L account the total expenditure of 50 lakhs incurred on extensive special initial advertisement campaign. Whatever you do, advertisement campaign, 50 lakhs should be charged to P&L. Next question. Naresh Limited acquired running business of Sunil Limited. So this is an amalgamation for rupees 10 lakh 80. The fair value of Sunil Limited's net assets was rupees 5 lakh 60. Naresh Limited is of the view that due to the popularity of Sunil Limited's product in the market, its goodwill exists. Okay. Naresh Limited had taken a franchise on July 2019 to operate a restaurant from Sankalp Limited for rupees 1 lakh 80 and at an annual fees of 10% of net revenues after deducting expenditure. The franchise expires after 6 years. Net revenues were 60,000 during the year 2019-20. Let me read the last point also. On 20th August 2019, Naresh Limited incurred cost of rupees 2 lakh 40 to register the patents for its product. Naresh Limited expects the patent's economic life to be 8 years. Naresh Limited follows an accounting policy to amortize all intangibles on a straight line basis over the maximum period permitted by accounting standards, taking a full year amortization in the year of acquisition. Goodwill on acquisition of business is to be amortized over 5 years. Guys, remember, AS26 says all the intangibles should be amortized over a maximum period of 10 years. Like this same way in AS14, I would have told you this point again and again when I was revising AS28. Okay, here again I am telling, as per AS14, goodwill can be amortized only for a maximum life of 5 years. Prepare a schedule showing the intangible assets section Naresh Limited balance sheet as at 31st March 2020. Simple. See, first point, these three are different transactions. Okay. Now Naresh Limited is acquiring Sunil Limited by paying how much purchase consideration? 10 lakh 80,000. So PC is 10 lakh 80. How much is NATO? Now those who are new to our classes, NATO means net assets taken over. Whatever assets that you have taken over from that company. How much is it? 5,16,000. Now, actually you got assets worth only 5,16,000. Then why are you paying 10,80,000? The extra you're paying because you feel that company has goodwill. How much extra you're paying? 5,64,000 will be shown as goodwill, and this will be amortized over a period of 5 years. So 5,64,000 is the initial goodwill. So if you charge it over a period of 5 years, the amortization will be 1 minute. $5,64,000 divided by 5, it will be 1,12,800. If you subtract this, the carrying amount will be 4,51,200. This is what will be shown in notes to accounts. So first one is clear. Let's go to the next one. Naresh Limited had taken a franchise. So now what is this franchise? You will get a right to run the business that they are doing under their name in your place. Now, if you see all these Domino's Pizza are there, right? They are not actual Domino's Pizza. Some local person is going to Domino's, getting their franchise. In other words, it is the right to use their name. So like that, then they will get a franchise. Then only they can start using the name Domino's Pizza. So actually, if you go and see, avanuku on the US like a Domino's Pizza, that is a local guy. He is just using Domino's brand name, Domino's franchise to attract people. Naresh Limited got a franchise from Sankalp Limited. How much they paid for that? 1,80,000. So whatever money you pay to get this franchisee rights, that will be capitalized as an intangible asset. They will pay this 1,80,000 upfront, and then every year, whatever net revenue you make, in that net revenue you have to give 10% to that Sankalp Limited. Now 2 payments you have to make. One is this 1,80,000. This 1,80,000 will be capitalized and shown as an intangible asset. It should be amortized for a period of 6 years. So 1,80,000 by 6, 30,000 will be the amortization. So 1,80,000 minus 30, 1,50,000 will be the carrying amount of the franchise in the balance sheet. Sir, but I have one doubt. They acquired this only in July, no sir. So July to March, 9 months, no sir. See, actually in this question, what they have given, they want to take full year amortization in the year of purchase. So any day you buy, you will charge amortization for full year. Now sir, is it as per accounting standards? No, it is not actually as per the accounting standards to do like this. But since question is telling, we are doing. Okay, so we won't consider the date of acquisition. We will charge amortization for full year. Sir, now we have a net revenue of 60,000. No sir, on that 10% we have to pay. No, what to do with that? That should be charged to P&L. That 60,000 into 10%, 6,000 which you are paying to them should be charged to P&L. Last case, on 20th August 2019, Naresh Limited incurred cost of rupees 2,40,000 to register the patent. So this is the amount paid at the time of acquisition of patent. This can be capitalized, and useful life is 8 years. So per annum, 2,40,000 by 8, 30,000 will be the amortization. So 2,40,000 minus 30, the carrying amount will be 2,10,000. This total of all these 3 intangible assets will be shown in the balance sheet under the head intangible assets. So prepare this extract, also show the notes to accounts, and show how you have arrived at these amortization numbers. Definitely you will be able to score full marks in this. Clear? Okay. A company had deferred research and development cost rupees 450 lakhs. Sales expected in the subsequent years are, so they are having these sales expectation. You are required to suggest how should research and development cost be charged to P&L, assuming entire cost of 450 lakhs is development cost. So we are assuming it is development cost, it is meeting all the conditions, so it can be capitalized. You have to show now how to amortize it. If at the end of 3rd year, it is felt that no further benefit will accrue in the 4th year, how the unamortized expenditure would be dealt in the accounts of the company? Very simple. 450 lakhs totally you have spent. Now we have to decide how to amortize. Sir, how to amortize? Very easy. They have given you sales ratio. In the sales ratio, it has to be amortized. So total sales 1,200, 2,100, 2,700, 3,000 are total sales. In the total sales of 3,000, 1,200 in first year. So 450 into 1,200 divided by 3,000. So first year it will be 180 will be the amortization. Okay, sorry, there is some printing issue here. Okay, so this should not come here. I'll correct it when I send you the PDF. So in the ratio of the sales we have to amortize. Now they're asking one more question. At the end of third year, if it is felt that there is no further benefit, idhukku mela benefits illa, recoverable amount is zero, then whatever carrying amount is there at the end of third year, that needs to be impaired and entirely charged to P&L, and the asset will become zero because there is no future benefit. When there is no future benefit, asset cannot be shown in the balance sheet. Next question. X Pharmaceutical Limited seeks your opinion in respect to the following accounting transactions. Acquired a 4-year license to manufacture a specialized drug at a cost of 1 crore at the start of the year. Production commenced immediately. Yes, this license can be capitalized, and this license will be capitalized as an intangible asset because it's a separate external purchase. It is identifiable. You can sell this license also separately, and this one will be amortized over the useful life. So this can be capitalized because it is a separate identifiable asset and there are economic benefits to the entity also. So this can be capitalized. Next, also purchased another company. This is amalgamation at the start of the year. As a part of the acquisition, X Pharmacy Limited acquired a brand with a fair value of 3 crores based on sales revenue. The life of the brand is estimated as 10 years. Sir, brand, sir, you cannot recognize, sir. No, internally generated brand only cannot be recognized. But this is not an internally generated brand. This is an acquired brand. This can be capitalized. This 3 crores will be capitalized and it will be amortized over a period of 10 years because that is the maximum life it can be taken. Spent 1 crore on advertising. Advertising, but advertising P&L during the first 6 months. Subsequent sales have shown a significant improvement and is expected to continue for 3 years. Subsequent, there is more sales. It will give you more benefit for 3 years. Hey, there is future benefit, so we can capitalize. No, advertisement expense should be charged to P&L. Don't even have a second thought for that. It has commenced developing a new drug A. The project cost would be 10 crores. Clinical trial proved successful and such drug is expected to generate revenue over the next 5 years. Cost incurred accumulated till 31st March 20X1 is 5 crores. Balance cost incurred during the year 20X1 to X2 is 5 crores. So now they have spent totally 10 crores for this drug. So total development cost that you have spent is 10 crores and it is successful. So this total 10 crores will be capitalized as development cost in the financial statements and it will be amortized over the useful life. It has also commenced developing another drug B. It has incurred 50 lakhs towards research expense. Till 31st March 20X2, the technological feasibility has not yet been established. We all know research expense itself should be charged to P&L. So this 50 lakhs should be charged to P&L. I hope you understood, guys. This is a question from actually final textbook Ind AS 38, but it is very, very much relevant for AS 26. So it can be tested even at an intermediate level. Tomorrow you cannot go and complain to ICA saying it's a final question out of syllabus. No, this all are within our AS 26 syllabus. Next question. Honey Limited is in the process of developing a new production method. Okay. During the financial year ended 31st March 2023, the total expenditure incurred on development of its production method was rupees 98 lakhs. Totally how much they spent? 98 lakhs. On 1st January 2023, the production method met the criteria as an intangible asset. On the development phase, the conditions those were met only on 1st January 2023 and the expenditure till the date was 68 lakhs. Day Gavani, Mottama you have spent 98 lakhs. In this, 68 lakhs was spent before satisfaction of conditions. Remaining 30 lakhs only was spent after satisfaction of conditions. So this 68 lakhs, since it was incurred before satisfaction of conditions, this should be charged to P&L. This 30 lakhs which was incurred after satisfying conditions, this can be capitalized. This can be capitalized. I hope you are very clear. Further expenditure incurred on the new method was 72 lakhs for the year ended 31st March 2024 day. Now 1st January 2023, all the conditions got satisfied. That means whatever money you spend after 1st January 23, you can start capitalizing. So already 30 lakhs you have capitalized, which was incurred in the year ending 31st March 23. Now again next year in the year ending 31st March 24, you have incurred another 72 lakhs. That 72 lakhs also can be capitalized. And the recoverable amount of the know-how embodied in the new method for this financial year is 52 lakhs. You are required to calculate the carrying amount of the intangible asset as on 31st March 23. See the dates carefully. 31st March 23 now, in the 72 lakhs you wouldn't have incurred, because this 72 lakhs was incurred in the year ended 31st March 24. For the year ended 31st March 23 now, this 68 lakhs would have gone to P&L, so it will not form part of the carrying amount. Remaining 30 lakhs only will form part of the carrying amount. So that will be the carrying amount as at 31st March 2023. Next. The expenditure to be shown in P&L for the year ended 31st March 2024, the 24, whatever amount you have incurred, see, initially 30 lakhs was there. Now another 72 lakhs you have incurred. So what will be the total carrying amount? 1 or 2. And a day, this is intangible asset still under development. What is AS26 saying? If an intangible asset is under development, it should be put to impairment test every year, whether or not there are indicators. So carrying amount 1 or 2. Recoverable amount kitna? 52. Carrying amount 1 or 2, recoverable amount 52. That means there is an impairment loss of how much? 50 lakhs. This impairment loss of 50 lakhs should be charged to P&L, and after charging impairment loss, the carrying amount will be our 52 lakhs. 52 lakhs. Hope you are very clear with that. So this is the impairment loss. This will be the carrying amount. Next question. We have done almost 2 more questions. Quickly we'll close it. Plymouth Limited is engaged in research on a new process. So they're doing some research for its product. It had incurred rupees 10 lakhs on research. Whatever you spend on research should be charged to P&L with the first 5 months of the financial year 2020-21. The development of the process began on 1st September 2020 and up to 31st March 2021, a sum of 8 lakhs was incurred as development phase expenditure, which meets the assets recognition criteria. So AS26 sort of recognition criteria is satisfied. So this 8 lakhs actually can be capitalized. From 1st April 2021, the company has implemented the new process, and it is likely that it will result in an after-tax savings of rupees 2 lakhs per annum for the next 5 years. The cost of capital is 10%. The present value of annuity factor of rupees 1 for 5 years is 3.7908. Decide the treatment of research and development cost of the project as per AS26. This is a nalla question. First, in the 10 lakhs, either research expense, it should be charged to P&L. Then this 8 lakhs development phase expenditure, condition satisfied. Yes, sir, they have clearly given the question. So this 8 lakhs can be capitalized. So this 8 lakhs will be the carrying amount. Now, Gavani, we have to do impairment test. If you remember, impairment test is higher of NSP, net selling price, NSP or value news. Value news is nothing but the present value of future cash flows. Hope you remember. Ipo in the question la NSP kudukala. Sir, how will I calculate recoverable amount? If NSP is not given, you can take value news itself as recoverable amount, which is the present value of future cash flows. Namakku future cash flow varundra every year 2 lakhs per annum. It is coming for 5 years. And what is our discount rate? 10%. Sir, discount pannilama? Avan unakku romba easy ah pantan. Avane unakku annuity factor kuduthan. So idukappuram unakku if kannu therinja podum, calculate use panna therinja podum, value news you can calculate very easily. 2 lakhs is the benefit into annuity factor 2 into 3.7908. How much is this? 3.7908. So it is 7.5816. This is your recoverable amount. Carrying amount is 8 lakhs. So it is more than recoverable amount. So there will be an impairment loss of 0.4184, which should be charged to P&L, and 7.5816 only will come in the balance sheet. I hope you are very clear with that. That 7.5816 they have rounded off to 7.582. So I hope you are very clear with this. This 7.582 will actually be amortized over the useful life of that intangible asset. Last question on exchange. Remember guys, commercial substance. Sun Limited acquired a software from Earth Limited in exchange for telecommunication license. So what happened? Sun, Earth. Sun gave telecommunication license. Earth gave software. So they have essentially exchanged intangible assets. The telecommunication license is carried at rupees 5 lakhs in the books of Sun Limited. So Sun Limited books la in the license carrying amount kitna 5 lakhs. The software is carried at 10,000 in the books of Earth Limited. So Earth Limited la the software's carrying amount was 10 lakhs, which is not the fair value. Okay. Past journal entries in the following situations in the books of Sun Limited as well as Earth Limited. Okay. Fair value of the software is 5,20,000. Software of fair value 5,20,000. Fair value of the license is 5 lakhs. Now first we will see from Sun Limited perspective. Did they tell there is no commercial substance? No. Then you assume that there is commercial substance. Otherwise whatever fair value data that they are given is not useful. So avanga kashtapatte fair value data kudutangla. Appa what is a rational assumption? To assume that there is commercial substance. Okay va? Now what we have learned, when there is commercial substance, whatever asset is acquired, it should be accounted at fair value of the intangible asset given up or fair value of the intangible asset taken over, whichever is clearly evident or whichever is more reliably measurable. Sir, now both are reliably measurable. Appa what should I do, sir? Then Sun Limited should give more importance to the fair value of the intangible asset that it has given up. Sun Limited எதை sacrifice பண்ணா? Telecommunication license sacrifice பண்ணா. அப்போ what is the fair value of that? 5 lakhs. So that should be used by Sun Limited. So Sun Limited journal entry பாரு, software account debit, how much they have used? 5 lakhs. To telecommunication license, what is the carrying amount of the telecommunication license in their books? Adhe 5 lakhs. So to telecommunication license 5 lakhs, there is no profit or loss. Sir, now what will Earth do, sir? Earth has given up which asset? Software. So Earth will use fair value of the software. What is the fair value of the software? 5,20,000. So telecommunication license account debit 5,20,000. They have given up software and the software book value is only 10,000. So remaining 5,10,000 is a profit on exchange which will be taken to P&L. This is case 1. Case 2. Fair value of the software is not measurable. Fair value of software theriyada. However, similar telecommunication license is transacted by another company at rupees 4,90,000. So we know fair value of the telecommunication license, but we don't know the fair value of the software. Now let us first think from Sun Limited perspective. Sun Limited, the asset he is giving up? Telecommunication license. Do we know fair value of the telecommunication license? Yes. What is the fair value? 4,90,000. So software account debit 4,90,000. He is giving up telecommunication license. So the carrying amount of credit panniduma. So to telecommunication license 5 lakhs. Remaining 10,000 will be a loss which will be taken to P&L. Clear? Now let us think from Earth Limited perspective. Earth Limited is giving up which asset? Software. So, but do we know fair value of the software? No. Appa we don't know the fair value of the asset given up. Then what we should do, sir? We have to use fair value of the asset taken over, which is which they have taken over a telecommunication license. Other fair value 4,90,000. I am repeating. Earth Limited has given up which asset? Software. Do you know fair value of the software? No. So if fair value of the asset given up is not known, then we should use fair value of the asset taken over. The asset taken over here is software. So I'm sorry. The asset taken over here by Earth Limited is telecommunication license. So since fair value of the asset given up, which is software, is not known, they will use fair value of the telecommunication license, which is 4,90,000. So telecommunication license account debit 4,90,000. They are removing software, so it should be created at 10,000 book value. Remaining 4,80,000 will be profit on exchange, which should be taken to P&L. The last case. I hope you are clear with this. Day account pannambodhu, if you know fair value of the asset given up, give importance to that. And the amount new asset should be debited. Old asset should be created carrying amount. Difference will be profit or loss. In the first two cases, we have assumed there is commercial substance, hence we are using profit or loss. Okay, va? And then if you don't know fair value of the asset given up, then use fair value of the asset taken over. Last case, neither fair value of the software nor telecommunication license could be reliably measured. Commercial substance irunda kuda, even though there is commercial substance, we don't know fair value of both asset given up as well as asset taken over. Sir, we don't know fair value of both the assets. Now what to do? Very, very simple. Sun Limited in their books will use the carrying amount of the asset given up. Sun Limited either give up panta telecommunication license. Upper journal entry in the books of Sun Limited will be software account debit to telecommunication license. Do you remember? Two cases P&L varakudadu. One, if there is no commercial substance. Two, if you are not able to reliably measure any fair value, then also P&L should not come. So whatever is the telecommunication license amount, transfer that to software account. So software account debit to telecommunication license 5 lakhs. Sir, now what Arth will do? Arth also same thing. Arthad books software account or balance irkuma. There will be a balance in software account that should be transferred to telecommunication license account. So telecommunication license account debit to software account. I hope you have clearly understood this. Please remember at that during exchange, in two cases we will never have P&L. One is if there is no commercial substance. Two, if fair value of the asset taken over and fair value of the asset given up, if both are not reliably measurable, then you cannot, then the journal entry should never have P&L. Whatever is the carrying amount of the asset given up, that should be taken for the new asset. P&L should never come. I am repeating, if there is no commercial substance and if neither fair values are reliably measurable, then no P&L should come in the journal entry which is passed for exchange of assets. Hope you are very, very clear. Okay, we have thoroughly discussed AS26 with a lot of interesting questions as well. I will put this PDF in Telegram group. Ensure you practice these questions before the exam. All the very best. Next, we have only two more very important standards, AS13 and AS16, which I'll cover in the next two sessions. Thank you so much and all the very best.